Hello everybody and welcome to this video where we will be running over the top 5 social media / advertising companies. We have today selected, as you could see in the introduction, Facebook, Google, Pinterest, Twitter and Snap. First, we want to understand whether these companies are in what we consider an uptrend or a downtrend. So if we take a look on the stock performance for the most recent periods, we can see that it is green across the board. Year to date, Facebook has gained 35.50%, Google 19.95%, a really high 172.59% for Pinterest, 56.88% for Twitter, and Snap has gained 138.64%. One thing to note about Snap is that they just announced their quarterly results, both beating the expectations on revenue and EPS. So as you can see here, there has been a nice positive trend just from the last session, but also from the last week with 40%. So really good numbers that Snap came up with, and you need to keep those in mind when we run over this video, because the numbers showing does not reflect the ones from the most recent quarter that was announced just a day or two ago. So if we first take a look at the income part, we obviously want to understand whether these companies are earning any money. So if we first take a look at Facebook and Google, they are basically just cash machines, huge profits, so really good here. Pinterest, Twitter and Snap for the last 12 months have all lost money. However, as just mentioned with Snap, they just reported adjusted earnings of a positive 1%, which was really good. So that is one of the reasons why the stock jumped so much the last week. If we take a look at the net profit margin for the last 12 months, we can again see that compared to the industry, Facebook is superior with 31.30%, Google doing respectively 18.99%, Pinterest has lost 32.87%, Twitter down with 37.06%, and Snap down with 57.18%, not considering the recent quarterly data that was announced just a few days ago. We can also take a look at the B-niche M-score, which is just a mathematical model that determines whether a company has manipulated its profits. We want this to be below minus 2.22, and all companies are in the green zone here. The same with Sloan ratio, it identifies a substantial part of the earnings are non-cash accruals, which we're not interested in. We want this to be between 0.10 to 10%. And we can see all companies, with the exceptions of Twitter, which is not really that bad, it's minus 11.53, are all in the safe zone. Alright, so if we take a look at the overall ranking, we first looked at the trend of these companies, and we could see that all of them are in what we consider an uptrend. On the net income part for the last 12 months, Facebook and Alphabet were positive, and Pinterest, Twitter and Snap was negative. On the net profit margin, Facebook was doing the best, followed by Alphabet, Pinterest, Twitter and Snap in the end. However, as we just mentioned, the last quarter from Snap was really surprisingly positive, so take this number with a little bit grain of salt. Next, we move into the return metrics, and basically what we want to understand here is how high returns on cash flow margins is being generated. So if we first take a look at the return on invested capital, what we can see is Facebook is outperforming the industry with 24.07%, really good. Google, respectable 12.84%, minus 68.54% for Pinterest, minus 17.53 for Twitter, and minus 54.93 for Snap. So a huge difference between these companies as of today. We can also take a look at the levered free cash flow margin, and it's close to the same story here. Facebook doing the best, followed by Google. Twitter actually doing quite well here with 14.16%, Pinterest 0.38%, and Snap has a minus on 12.84%. Next, we obviously want to understand for these type of companies, how strong is their balance sheet, especially for the companies who are losing money. We need to understand, is this something that they can sustain for a longer period through their balance sheets? First, we can take a look at the current ratio, which just looks at the current assets versus current liabilities. We want this to be above 1, and as you can see here, all companies are looking really nicely here, no issues at all. The same on the cash ratio, we want this to be above 1. All of them has no problems meeting this target, which also gives a bit greater comfort in terms of them losing money these days, because it means that they actually have the cash to sustain this. And for companies obviously like Facebook and Google, with the cash that they have, they can use that for future growth by acquisition of various companies, which they're doing on a regular basis. So really, really strong numbers here. Can also take a look at the total assets versus total liabilities. Want this to be above 1.5, and again, all companies are surpassing this. Same on debt equity ratio. It's looking fine across the board. Really, really good numbers financially. So I'm not too concerned about any of the companies from this perspective. You can also take a look at the Element Set score, which is just a credit strength test that assesses the likelihood of bankruptcy. We want this to be above 1.8, and again, all companies are meeting this by far, so again, no risk here. The Piotrowski score is another way to assess the strength of the company's financials. We want this to be equal or above 5, and we can see that Facebook, Alphabet and Pinterest are doing quite well. Red flag here for Twitter, but again, I prioritize Altman Set score above Piotrowski score. So again, no big concerns. The same with Snap, who scores a 4. So back to the overall ranking, we looked first at the return on invested capital, and what we saw was that Facebook was by far the best, followed by Alphabet, Snap, Twitter, and Pinterest. Undelivered free cash flow margin, close to same situation. Facebook doing the best, followed by Alphabet, Twitter, Pinterest, and finally Snap. We then moved into the balance sheet and we looked at the total ratio. And again, what I want to emphasize is that was looking really well for all the companies here, but Pinterest had the best, followed by Facebook. The same on the debt equity ratio, it was looking fine across the board, but Alphabet was doing the best, followed by Pinterest and Facebook. Next, we move into the shareholder yield, and we want to understand how much value is returned to shareholders through either dividend and or buyback, if any. And as we can see here, none of these companies are paying any dividend as of today. On the buyback yield part, small 0.64% from Facebook, generous 2.25% for Google, 0.51% for Pinterest, and then both Twitter and Snap has issued more shares than bought back, so therefore they have a minus. So that gives us a total shareholder yield, which we can see here. We obviously want to understand whether this is sustainable, so we look at the modified payout ratio, which just shows the proportion of earnings paid to the shareholders in the form of dividends and buyback. We want this to be below 100 because that means that there's room for improvement. On Facebook here, you can see 21.52, so again, really solid. They definitely have room to improve either dividend and or the buyback. Google, here 78.14%, it's okay, but compared to the industry, it is not that good. Pinterest are actually borrowing money to do buyback, so that's really not good, and that's a bit of a red flag. And Twitter and Snap, really nothing to mention about. Next, we move into the earnings per share and growth. We can first take a look at the P/E ratio here, which for Facebook and Alphabet is good compared to the industry that they're in. We cannot see it for Pinterest, Twitter, and Snap, obviously, because they had a negative earnings. Then we can take a look at the earnings per share growth forecast for the next 5 years, which is looking relatively okay for Facebook with 20.27%, but not exceptional compared to the industry that they're in. And the same with Google on 4.81%. But again, these companies are perhaps a bit more mature than some of the other companies that they're benchmarked against, and that may be the reason that they're scoring a bit lower compared to the industry. So again, as long as it's positive, it's actually quite good overall, at least from my perspective. We can also take a look at the revenue growth for the past 5 years, and we can see really good numbers across the board, where specifically Snap stands out with 70.96%, but also Pinterest and Facebook doing well with around 40%. On the net profit growth for the last 12 months, I think that is very interesting to see given the current situation, pandemic situation we're in. And as we can see here, Facebook, again, the net profit growth has gone up with 56.28%, really strong number. Google losing 7.8%, so not really good. Pinterest minus 221%, that's really a big red flag for me. Twitter also down with 120%. It's also a really big red flag for me. And as we can see here, Snap had a loss of 5.45%, but as the given quarter showing that they were actually earning money from an adjusted perspective, that tells me that this number may turn into profit, and that's something that I really want to investigate further. So back to the overall ranking, we first looked at the shareholder yield, which is not too important for the companies that we are evaluating today. However, Facebook was doing the best, followed by Alphabet, Snap, Twitter, and finally Pinterest, which was quite bad. On the earnings growth, we first looked at the revenue growth for the past 5 years. You can see Snapchat has been doing the best, followed by Pinterest and Facebook, but in general, all companies were showing quite good numbers. On the net profit growth, Facebook was outcompeting everyone else with a big mile. Snap maybe turns into profit now with the most recent quarter, but otherwise the numbers for the rest of the companies were not that good, specifically for Pinterest and Twitter. Final section is to take a look at whether these companies are currently under or overvalued, and we have different ways of doing that. One way is to look at the PEG ratio according to Peter Lynch, and basically if it's below 1 it means that they are undervalued. If the PEG ratio is above 1 they are considered overvalued, and as we can see here, both Facebook and Alphabet is considered overvalued from this perspective. Because they have a negative PE ratio, we cannot calculate it for the 3 other companies. Next, we can move into my own estimated intrinsic value, which is quite difficult for these companies. However, based on my assessment, I believe that there's an upside on 6.15% on Facebook, downside on 25.12% on Google, which came as a bit of a surprise, minus 19.64% on Pinterest, minus 21.12% on Twitter, and lastly, minus 9.62% on Snap. However, I would say that this number may be adjusted based on the most recent quarter that Snap has just issued. You can also take a look at the beta ratio, which just shows the stock's volatility in relation to the overall market. If it's below 1, it is less volatile. If it's above, it's more volatile. And as we can see, Facebook, Google don't have the number for Pinterest, and Snap are considered more volatile, while as Twitter, surprisingly, are considered less volatile. Next, we can also look at some other value indicators. One of them is the book value per share. Again, if this is above 1, they are considered undervalued, and by no surprise, all of them are below 1, so they are considered overvalued. The next one is the relative strength index for the last 14 days. We want this to be below 30 because that means that they're oversold. If they're above 70, they're considered overbought. You can see Facebook, Alphabet, and Twitter are in the middle range. However, Twitter is getting close to the 70 mark. Pinterest and Snap are by far into overbought territory, and this is a little bit of a concern to me in relation to those two companies, especially Snapchat, who just announced good quarterly result. This may still indicate that there will come a pullback in the stock. For the others, no clear indication yet, although Twitter is a bit on the high side. Lastly, we can also take a look at the analyst recommendation and what is their perspective. And although I do not follow them blindly as they have their own agenda, I always think it's good if numbers are telling the same for them as it is for me. It's good to get some support on that. So if we take a look at their consensus price target, which is just the middle ground estimates of all the analysts, we can see that they believe that there's a 2.33% upside on Facebook, 5.04% upside on Alphabet, so quite a difference from my numbers. A downside on Pinterest on 25.03%, downside on 28.02% downside on Twitter, and a downside 16.12% on Snap. So finally, we want to take a look at the overall value assessment based on the different factors that we just looked at, and based on those, our analysis tells us that Facebook is undervalued, Alphabet is fairly valued, Pinterest, Twitter, and Snap are overvalued, I do understand that the numbers may have to shift for Snap based on the most recent quarterly report. However, I would say the relative strength index is up in 90. So that is a clear signal that there may come a pullback in the near future, and then it may be a good opportunity to look into putting some money in Snap. Alright, so based on today's video, there's definitely one stock that is standing out amongst the others. We have owned this stock for quite some time, since it was in the low hundreds, and have taken the ride up with it. And we still believe that based on there's room from its 52-week high, it has a strong return on invested capital on 24.07%. It has a very solid balance sheet that can be used for investment. Its revenue and profit growth continuously improves. And the estimate is that there's still upside for this stock. We believe that the best pick is Facebook. This is a cash machine. They're touching more or less all the people in the whole world. Facebook is continuously showing that they can adapt, improve their business, find new ways of making money. It may not be the most popular companies, and the regulators may have a bad eye towards them, but we still believe that there's upside for Facebook in the future, and we are positive that they will become $1 trillion company. The other two that we have selected is Alphabet. Alphabet seems a bit overvalued, fairly valued at this stage. However, they are being sued now by the US government, and although the share price didn't really react negatively to that, no one knows how that is going to turn out. So even though we have a feeling that Alphabet will pass the expectations from the next quarterly report, we are still a little bit concerned about whether we should enter into a position on them. Snap, again, as we have said a lot of times in this video, just came out with really good quarterly results that has to be investigated and analyzed a bit further. The stock seems a bit overvalued as of today. However, if there comes a pullback, there may be a good opportunity to go into Snap. I will though say that we will have to do some more investigation and analysis on Snap and its future potential to grow their revenue and become a consistent, profitable company. If they can manage to do that, it could be a really attractive play. This was all for today. Please note that we are not financial advisors and this is only done for entertainment purposes. Please like the video, subscribe for future content, provide a comment with some suggestions, and except that, we're just gonna wish you a very good day. Stay safe until next time.